hold up before.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone.
Hey, isn't that great? That's like such a huge improvement. There is hope for the future. AI is moving along very nicely, apparently. And that was nice and good and less errors than the other one made. I'd say no errors, frankly, except for like when it says losses. About how would you actually read that if you're reading it out loud? So I think that's fine. So I'm very happy about that. Now we have a better functioning thingamajig. And whoa, and the markets are shooting back up. Ah, my NASDAQ position. Hang on. Wait. Damn it. Oh, I should have taken more money off the table. Ah, I had 4. Oh my God, look at that. Holy crap. That was in the last 15 minutes. Well, we are off to the races now. I guess that's it for those. I hate to take them off now. Up 5,000 for the day, 210. I'm disinclined to take them off here. It's too much of a run up. Where are we? The NASDAQ is now, it is not plus 190, is it? Holy crap. Oh, no, that was short, dumbass. Damn it. Did the wrong thing. Oh, cancel those orders. It's going up so fast I can't get out. Oh, no, you're kidding me. Look at that. Lost $1,400 while I was deciding, and now it's going down. You bastard. Well, that's the fun of trading the futures. Still, it's all right. The idea is to have a hedge. You don't need a downside hedge. We're okay. So speaking of which, we are supposed to be going over the portfolio. So let's start doing that because I want to go over our positions and see where we are. Feel free to ask questions if you want. We just looked at the news. And, wants me to log in again. All right. So. Well, what will we do today? Let's just quickly go over that. So I was just talking about basically what's wrong with the Dow and how the Dow, we talked about this yesterday in member chat, like all these components that replaced other components in the Dow have served to pump up the value. And look, realistically, the index rebalances when they put them in. They put these components in one at a time. But when you put in a higher price component and the component goes up a lot after you put it in, like Apple was, $100 when they put it in, it went up 200. T hasn't gone anywhere. Cisco is whatever. UNH has gone up more than $150. There was no way that Kraft Heinz could have gone up $150. You know, so in other words, each component that they replace with a much more expensive component, the same gain in that component gives you a very outsized gain in the Dow. And they put them in, you know, a lot of them were put in 2008, 2007 when they were at their lows. So they put in it was very deliberate. They put in very expensive stocks that had been very beaten up to replace small stocks that were very beaten up, because when the stocks rebounded, they would get much larger gains and make the Dow look much better than it was. And that's how we got to where we are today. And then seeing the Dow barreling along, getting these great gains, makes people buy the S&P and makes people buy the NASDAQ. And they think the valuations are okay because the Dow is doing so well. So it's one big giant con game to get people to put their money in. From this low to here, almost half of these gains were caused just because they switched the components. So, you know, if you take that away, we're back to basically where we were before the crash, just a little bit higher, which is where we should be. If this was a normal progression, we should be up around here, not here. So you got to take all this stuff with a grain of salt. And also, I said, remember where you're getting your news from. You're getting your news from you know, who did this Dow manipulation? Rupert Murdoch bought the Dow Jones Company. Okay, you know, yes, they own the Wall Street Journal. He likes buying newspapers, but realistically, he could have bought Gannett, he could have bought the USA Today, he could have bought things with much wider circulation. He could have bought the freaking New York Times at that time because they were really struggling. But he bought the Wall Street Journal, not just for the journal, but to control the Dow Jones Corporation, which gives him incredible control. He gets to decide what he's going to include in the Dow Jones Industrial Average. And also they get to, and also he gets to steer the financial conversation. That's how he eventually manipulated his stock to get bought by Disney News Corp and got a huge payday out of that. So Rupert Murdoch made personally, not for his company, but made personally $15 billion since the crash in 10 years. Went from 4 billion to 20 billion, $16 billion. You know, and that's the thing. And all these newspapers, though, they're all controlled by billionaires. Look at Bloomberg. You know, I mean, these guys are the people who own the press. So the things you read, the things you see, everything that, you know, all your opinions, even the internet you're looking on that you think is independent, it's all owned by these people. So, you know, and then of course they're going to tell you not to worry about the virus and to buy stocks because they want to keep selling you stuff. So that takes us up to lunch. I have my lunch here, my poke bowl. News. Okay, so here's the thing. You know, you got to look at the news. You got to figure out a general consensus in your mind about what's going on with the virus. Here's a good point. Here's the virus from last, whoa, where'd it go? Here it is. Here is last week's coronavirus chart, Control C. So let's do a side-by-side thingy. Hang on. There we go. All right, so last week we were here. This week, if I do this correctly, yes, okay, cool. And this week we are here. So are we under control or are we not under control? Last week, 81,000 cases. This week, 94,000 cases. That's 20% more cases, roughly. How many more people are dead? 500 people more dead. That's 20% more dead. 20% more cases, 20% more dead. How many people recovered? A lot more people recovered. 60% more people have recovered. That's good. Where are we statistically? Here it was almost 1 out of 10 people are dead who recovered. Here it is now falling back to 3 out of 5, which is 40%. So wait, not 40%, 4%. Sorry. Is that right? 5? No, it's not right. 6%. Sorry, 6%. So here it's about 8, 9%, and here it is 6%. So these are good signs, okay? But Not great when 20% more people are getting sick. So good, but not great. Look at Asia now. That's like completely, I'm not sure why there's a big circle. I'm not sure what that means. But anyway, so big, huge circle, little circles blotted out completely. Asia. Europe is now being obliterated by the virus. The Middle East obliterated by the virus. America is working on their own little clusters of virus. This is not good. This is what's really killing us. Look at this. China got under control, but South Korea went from 1,200 to 5,600. That's 4,600 more. So that's roughly 4 times more infected people than they were last week. That's a lot. Italy went from very mild 375 to 2,500. That's a lot more. Japan 178 to 304. That doubled in Japan. And who else? Iran wasn't even a thing. Iran, 20 times more people infected in Iran. Germany, was Germany even on the list here? 19 to 244. Okay, France wasn't even on the list. Now it's near the top. France, 17. France was 17, and now France is 212. Spain also not really on the list, 12, and jumped up to 193. US down, way down on the list. US. Wait, where'd we go? What? Did I miss this? Oh, there we are, 57. 57. Actually, we're not doing so bad. 57 to 128 is not that bad compared to other people. Singapore, very under control, right? Singapore, 93 to 110. And that's actually a good sign, though. That does show that there are ways to contain it. Unfortunately, Hong Kong also under control, right? But the problem is that Singapore and Hong Kong are both authoritarian governments, although Hong Kong pretends not to be, but they are. They still have that Chinese backbone. So Singapore completely tight controls over their people. Thailand also very tight military controls. Thailand tells you to do something, you do it. So Thailand went from 40 to 43. Okay, you have a combination of obedient people, not a negative thing, but obedient people, meaning when the government tells them to do something, do it. If the government says stay home, they stay home. If the government says wash your hands, they wash their hands. It's like people listen. It's very hard to control Western people like that, to get them to do what you say. And there's this overall distrust of government, especially in Europe and America. We don't even trust our government. So if they tell you to do something, you're not that likely to do it. So the thing is that so mainland China and the Asian countries, you can see, other than Japan, which is having a bit of a problem, but the mainland countries, but also that's because Japanese people aren't quite the same as the other Asian people. They're not really going to listen to their government the same way as the other Asian countries do. Mainland China, only 2,000 more cases, very encouraging, but globally there were 13,000 more cases. So that means globally we went from 3,000 cases to 14,000 cases. That's not good. It is not under control. And as long as it's not under control, you have to take it as a serious threat. So that's where we are now. This will be interesting. Let's save this for next week. So I'm going to put it back on the tab, and hopefully it won't get messed up next week. And that's a nice little historical snapshot that we can keep. So we have 2 weeks. We have last week, and we have this week, and next week we'll have another one, and we'll see where we see some changes, what's happening. But what I don't like at all, obviously, is the acceleration here on the current chart. Asia's flattening very nice. It's not Asia, sorry, it's China. Just China is flattening very nicely. They've got it. You have to say, as long as they're not lying, this is under control. Okay, recovery is going along well also, but the problem is here. This is a huge problem. Okay, because this is doing what this was doing back here. We're up to this spot right here. 20,000. We're getting right about 20,000 people infected in the rest of the world. And from there, we went to 40, and 60 and 80. And like I said, though, the problem is we're much more decentralized and much harder to control and contain this population. So I don't even want to say unlike China. It's almost silly to say unlike China, because look at what happened. But unlike China, we aren't going to be able to stop people from traveling and spreading this disease. And we're not going to be able to get people to not touch their face, wash their hands, and stay home, and so on and so forth. It's very, very hard to do. And the same goes for Europe, where it's already, whoa, yeah, it got worse. It's already covering, wow. Oh, that's horrible. Stop. It's spreading as we speak. All right, anyway, not good. So look, it's lovely that the market is rallying. It's rallying because other central banks are indicating that they're joining in and going to be lowering rates. And a lot of analysts are getting on board, and all the TV cheerleaders are telling you how things are getting better. And I'm not saying they're not going to get better. In fact, we're going to go through some bullish changes to our portfolios on the assumption that things are going to get better. But that's only because our hedges have been working so far, and therefore we are willing to take a bit more of a risk. All right, but I'll explain to you how we do the risk. So see if we have any questions first. No questions. Fantastic. I'm just going to barrel right ahead as if everybody's still awake. All right. Portfolios. Whoa, what happened? What is this? You logged me out? That's not nice. Portfolios. There we go. Okay. Oh, very important thing though before I go. All right, speaking of Thailand, if anybody is interested, we are raising $500,000 directly for our Thailand project, where we're building a hemp farm and a cannabis farm in Thailand. We have contracts to supply the National Health Service of Thailand, along with hospitals and medical clinics throughout the country. They have national health services with CBD and THC treatments. This is going to be a potential billion-dollar business. And we only need a very small amount of money to get the farm started. And this is step number one in creating this farm, is building a corporation, a structure to move it forward and gather the investment capital and so on and so forth. So that's the step we're on right now. We need $500,000, and and it's very quick money. So if you know people who like to invest in that kind of stuff, if you like to invest in that kind of stuff, it's an immediate thing, because we are moving forward with this phase in the next 10 days. So I'm talking to people all week long, but while I'm on a webinar with you guys, I'm letting you know that that's happening. Contact Greg at Phil Stockworld. He's our admin guy, and he can help you if you would like to get in touch with me, and we can discuss it. But that's basically how I'm spending the rest of my week for the most part, and certainly my whole weekend. I'm meeting with lots of people. You know, we're also raising $15 million for the main project, but this is a part that I care about right now. Is the first 500,000 is critical right now, and obviously you'll get huge leverage because of coming in early. All right, so let's see, Broadcom. Okay, what is this? Long-term portfolio. Okay, our long-term portfolio is down 15.4%. That's minus $75,000. Okay, and the now here's what I said. I didn't mind where we are, because if you look at the short-term portfolio, it was better, but now it's up 51%. It was like 60-something%. The short-term portfolio is up $50,000. So we're net down on our two portfolios. They're paired portfolios. The short-term portfolio is the hedges for the long-term portfolio. We're net down $25,000. So this entire market drop of the last week or so, if I can find the thing. So this entire market drop and all the disaster that's happened in the S&P, okay, has only cost us $25,000 in $600,000 two portfolios. That's fantastic, okay, because everything is still 10% cheaper than it was, so we can still buy things for 10% cheaper, but we have 95% or 96% of our money, or whatever the hell that works out to. All right, so we're only down 25,000. We have 97.5%. That's how much we're down. So we have 97.5% of our money is still available to us, yet stocks are 10% cheaper. Obviously, that's an advantage. That's what balancing portfolios is all about. Now, we're not going to buy the stocks that are 10% cheaper. We're going to buy the stocks that are 20, 30% cheaper. And we went over those a couple of days ago, and I'm not going to go over that now. I'm going to go over the positions we actually have and see which ones we can improve. So, and this is how we ended up making so much money last year. This is the point at which we look at our short-term portfolio and say, is there anything we want to really take off the table? All right, China Mobile. Well, if China's recovering, China Mobile is going to recover. No reason to take that off. And it's a nice cheap entry at 45 minus what we got for the options is 4. So 41 is our net entry, and they're at 40 now. So if we look at CHL, I'm sure 40 was a pretty strong bottom. CHL, yeah. So well, 39, but anyway, so 40 is basically a good bottom for them. We knew it wasn't going to go much below that, and as a long-term hold, they should be much higher. So it's a good position. Not worried about that. Tesla, remember we did this one last week. This is interesting. It's really just a teaching position because it's not like a big bet. But we bought 3 April 1000 calls. Not that we believe Tesla was going to go to 1000, just that obviously in case it did, because it's an insane stock, we wanted to have some kind of a hedge. We didn't want to risk 4 naked March 1000 calls, even though it's totally stupid. So we sold 1 extra call. So all we really did was take 1 naked March 1000 call. The others are covered. But we collected the same amount of money as we sold. In fact, we collected a little bit more money than we sold. We bought $24,000 worth of hedges. We sold 26,000. So if they both expire worthless, we would make $2,000. But since April is longer than March, these will hold up their value a lot longer than the March calls will. And you can see the March calls are already crushed. At the moment, it's not really worth taking it off the table because Tesla's going higher. So oddly enough, we're rooting for Tesla to go higher. And this is a little complicated, but it also works with the other trade. So Tesla is popping back up. The closer Tesla gets to 1000, the better that is for our April. But we don't believe in this at all. But we do also have another Tesla position with short 900 calls, and to some extent, these act as a these act as a buffer to the short 900 calls. Again, though, I don't think in any way, shape, or form Tesla's going that high. It seems ridiculous. This bet for January, September is that Tesla will settle between 550 and 900. This bet is more immediate for April. So, you know, honestly, 495, I think we may as well take that off the table. Probably should take the whole position off the table. It is a $6,000 profit, and it was the simplest spread in the world. See what we did? We took 3 longs for $24,000. We sold 4 shorts. They were ridiculous price. We never believed for 1 second Tesla was going to be over 1,000. But even if it was, it wouldn't hurt us very much because we only had net 1 short contract. And the time advantage meant we should hold our premium better than the other calls. So that's an almost perfect way to play a skyrocketing position. So when you have a momentum stock and you say, gosh, I want to make some money on that, you look for a trade like that. It's a ratio back spread. And you look for a trade like that where you can take really a small risk. You know, your small risk is that if Tesla goes over 1,000, if it goes to 1,200, you would lose $200. You would have 1 contract that went $200 over the mark. You lose $200. Is that right? Yeah, that's it. So if Tesla goes to 1,200, you lose $200. So realistically, that's kind of our risk. But we wouldn't lose 2 because we actually sold for we had a $2,000 credit. Am I doing this wrong? If it goes to 2, oh no, it's 200 times 1,000. I apologize. It's 200 times 100. So if Tesla went to 1,200, I'm sorry, if Tesla went to 1,200, the single short March call would be $20,000. Right, I'm sorry. But then it would be minus whatever value remained in the April 1000s. Now there would be 3 of those. and they would have some premium. So they would cancel out against the March calls, but there would also be some extra premium in these that wouldn't exist in the March ones when it expired. So maybe there'd be, who knows, if it's 200, maybe they'd be 250. You know, and if there's 50 extra premium, it would almost wipe it out. That's why I keep thinking it would wipe it out. It would almost wipe out the $200 additional gain. It's not a heavy risk, but the only way to prove that was to actually take the position. So we did that. But now, you know, at this point, I would say sensibly, it's not worth it because I don't see Tesla going much higher than where it is now. So this is maybe the most we get out of these. And these guys, I don't want to leave naked, just the same danger. So while we're up $6,000, we may as well take the money and run. See, and it's 6,000. This is basically 4,000 plus we had a 2,000 credit to start. So we're netting right there. You can see it. We're netting a $6,000 profit. Easy. Okay, and that's in 2 weeks. Boom, done. So that one we're going to take off the table. Chipotle. No, I'm sorry. Yeah, this is Chipotle. Chipotle, we said is not going to go higher than 900 in March, and that's a pretty easy bet. In fact, we're up 99% on that one already, so we could actually take that off the table. And we have the 920 puts. What? Wow, because we sold them for a freaking fortune. Oh, I see. No, we didn't sell them. We bought them. Okay, we bought them for a freaking fortune, and they're doing well. Holy cow. See, there's another position we should probably close because, I mean, who knows what's going to happen? I mean, I'm pretty sure it's not going to go to 900 in March, but it's only $5 left to gain. So that's the end of that position there. It's, you know, the excitement about this position in March is gone. And let's see what happened to them. I don't remember where it was at the time. That's way back on 12/6 we did this one. So look, here's the funny thing. It wasn't even that much higher on 12/6. It's just that it had been coming up really fast and March was still far away. So people were extrapolating that it was going to keep going like this and be over 900. It actually was over 900 for a while. So it was a nail biter for us, but then it dropped like a rock back to 750. And so clearly we're done with this one for sure. I'd say we're closing the whole thing. It's a nice game. Why mess around? Or we might sell some other puts on the side. Now FXP is the China play, and we have the short $50 puts. We're way over that. That's no problem. And we have the long $52 calls, and we're at 59, so that's no problem. All going well here. SQQ, of course, is our major hedge. That's up by a mile right now, so nobody's complaining about that. But we might do a little bit of covering on that one. TLT. Disaster. Okay, see, there you go. That's a big loss. TLT was obviously positive for us, and unfortunately, with the last Fed action, it changed it drastically. What are we going to do there? We're just going to roll it. Okay, this isn't going to last forever. We're going to roll it because if the Fed rolls back the rate change or does something else, rates will go back to normal and TLT will plunge. But right now, it's at a record high. And that's costing us 16,000 bucks. That's nasty. Tesla, as I said, this is our bigger Tesla one. We have $59,000 left to gain, though. We're not going to take this off the table. If Tesla stays below 900 into September, we get another $59,000. That's kind of hard to walk away from. If Tesla stays above 550 through January, sorry, we get another $38,000. We have like $100,000 left to gain on this position if Tesla stays between 550 and 900 through the year. That's a pretty wide freaking range. And if not, what do? We roll it. Big deal. UNG is basically on track to pay our full amount. And it's actually, see, it's funny because it's negative. Isn't that weird? It's completely on track. We paid the 13.15 spread. It's halfway between. It's at 14 something, 14.02. We sold the $15 puts, but we sold the $15 puts for almost $2. So our net is 13, but it's higher now. It's 257. So we're showing a loss. Even though we're on track, we're showing a loss on the puts. We're showing a loss on the long calls. All right, but if this trade closed now, we would net $4,000 on the. I'm sorry, we'd net zero on the trade. But currently, the trade is showing us a net negative $1,100 or so, or almost 1,200 bucks, almost 2,000. It's showing almost a 2,000 negative net. So obviously, no reason to change that. We might get a little more aggressive on it. In fact, considering the changes. And USO also similar boat, right? We're showing a loss, even though, well, it's actually at the bottom of our range, but we have the July 10 calls. We sold the, oh, these we're going to take off the table. We sold the 12 calls. And so we're going to take those off the table and allow USO to give us a much better gain if it goes up, and then we'll just sell some more calls again down the road. We got plenty of time. July is still our target date. Don't forget OPEC is meeting too. So OPEC, they're screwing around, but Russia's messing around. But eventually they'll come to a deal and they'll do a production cut. They'll even do a production cut if Russia doesn't participate. So I think the whole thing's a waste of time. And then we have the short 11 puts, and we sold those $4. So basically, they'd be even if this closed today. But they would be even. But at the moment, they're showing that we have a $1,500 loss. Even though they're exactly on, well, they're exactly on target for breaking even. $10 is break even for us, and it's at 990. But that's the thing. When you review your options, you have to review them understanding the mechanism of the options, because if you don't, if you just go by what your broker tells you, you would have a heart attack. You'd be like, oh my God, that's that and that's that. That's not the way it is though. You say, well, look, if this expired tomorrow, it'd be here. Is it on track or not? Is it heading to your target or not? The volatility makes, especially when you sell a lot of premium, the volatility makes your options look very, very bad sometimes. But those are sometimes the best times that you can take advantage of that volatility and do something about it. But you got to keep your head together. This is a great portfolio. There's nothing really wrong with these positions. We can take advantage of a few things, but in general, we're in great shape to make another $100,000. All right, see if there's any questions. Still no questions. Dan's thinking I have a sample. Well, if you invest, you can certainly have samples. Go to Thailand, have what you want. Yeah, there's a very, I could talk all day about it. It's a really exciting opportunity we have in Thailand. I mean, we actually have a contract to supply not only the National Health Service of Thailand, but the Thai military with CBD. They have the same problem that we have in the United States. And we're working with by the way, we're working with the Department of Veterans Affairs also in the United States. We have somebody inside on that. And the idea every country has the same problem. So we're using this as a model that we want to roll out all over the world, is the opioid crisis. It's a painkiller crisis. Opioids are painkillers. Countries want to use something else. Thailand spent $19 billion on pain medication last year in their National Health Service. They have 70 to 80 million people in the country. So it's about 1/3 the size of America. That's nothing, $19 billion. Of course, we spend like a couple of $1 trillion. I think we spend $3 trillion a year on healthcare. So, 19 billion is a nothing number, but it's a big number if you want to supply, if they want to replace their opioids with marijuana, THC, and CBD products that will substitute for pain medication. Now, obviously, it doesn't substitute for anything. It's not going to be a $19 billion market, but I don't care. If it's a $1.9 billion market, I can live with that. And that is what we're projecting. We're projecting it's going to be $1.9 billion are going to be eligible for replacements. And the first clinic that opened up in Thailand, which we have a contract to provide for, they were overbooked. There were lines when they first said people can come and get medical CBD and medical THC. Hundreds of people lined up the first day of this tiny little clinic in a small province in Thailand. They expected 20, 30, they told us, the numbers they told us, they said there were only gonna be 20 or 30 patients that were gonna come that day. Hundreds of people lined up all day to process everybody. It was crazy. So it's an indication of the demand there. It's just like anywhere though. It's the same thing you see in America when people line up for, when they open up a new marijuana dispensary. It's not like nobody's heard of marijuana. It's not like this medicine no one's ever heard of. It's like people say, oh yeah, great, I can get this legally now, let's go. Not only legally, but paid for by the government. I mean, how great is that? So you know, if you have an eligible condition, as long as you are no longer taking opioids, or, you know, and obviously they're prescribing it, so they know whether you're getting one or the other. As long as you're not taking your opioids and you're switching to THC CBD, the government's thrilled to do it. And we built in a cost structure across the board that's making it actually cheaper for the government to provide CBD and THC than it is for them to provide the opioids. So basically, it's basically 66 cents a dose is our net cost. That's what we targeted. So it's about the same price as taking aspirins for the hospitals. It's not much different. In fact, in America, Tylenol is $5 in the hospital. So it's in the US, it would save a huge amount of money, but in normal places in the world, 66 cents is about right. So anyway, huge project, massive opportunity. So we're very excited about that. How do you get on that again? Anyway, long-term portfolio. Let's go right to that because that's much more exciting than the other ones. And we'll go over the positions in this portfolio. So like I said, we're down 75,000 in the long-term portfolio. It should be about 425, 433, not even, no, 423. There it is. 433 is a cash on hand. Still have a tremendous amount of cash. And what do we have? We have Broadcom puts, and Broadcom, it's a 250 put. We sold the put for $26. That nets us in for less than 225. Broadcom's at 280. Yet the puts have shot up to 43. So again, this is one of those situations where you can't, you have to ignore what your broker is telling you. And this is a big hole in the portfolio. $21,000 loss on this position. It's an $8,000 loss, but it's costing $21,000 of the portfolio's negative value is here. So if it wasn't for that, we would be pretty much we'd be pretty even on the whole portfolio. So is this a realistic number? Well, no, it isn't, of course not, because it's still $30, more than 10% below the current price. And even then, it's another 10% before we break even. Yet currently it's showing us an $8,000 loss on the position. In reality, we fully expect to make this $21,000. This is a fantastic position. Just doesn't look fantastic, that's all, but there's a big difference. And when you're buying options, of course, you need to know that also. All right, we don't think it's going to go to 250. This has great support here. As you can see, this is really solid support. It's had very solid support all year. This line here has been great solid support. It's going to go up. If it doesn't go up, it's still going to have solid support for quite a long time. Also, it's a great company, and this is an incredible opportunity to get in. In fact, honestly, I'm going to strongly consider adding a bull call spread to this at this point, because we can now cheaply buy the bullish calls. ET Energy Transfer, flat, but also fine. It's a $10 put. The stock's at $11.50. What's the problem? We sold the put for $2.20. Our break even is $7.80. It's miles away. Exxon, that's a pretty new one. We took advantage of Exxon when it dipped. We sold the $50 put for $6.50. That's a net entry of $43.50. I doubt Exxon came anywhere close to that, even at the low. Whoop, wrong thing. Shoot, go away. There it is. XOM. So again, we're $43.50. All right, it is in a downtrending range, but I basically put a value thing down here and said this is good. Also, I read, we didn't go through all the news, but let me see. There was a note on CVX. Control F, CVX. Chevron's lavish promises look well supported by the balance sheet. So, in other words, Chevron is saying that things are not as bad as you think, and they're showing capex, blah blah blah. So there's nothing Chevron's doing that Exxon isn't doing. So when I read this about Chevron, I don't have to find an article about Exxon. I know that they've obviously similar balance sheets, similar company. They do the same diversification things that Chevron does, all very similar. So it's going to be. They don't feel that this is going to be a huge problem. They're happy about where things are, and they see oil prices rebounding. And if oil prices rebound, these stocks will rocket up. So we just decided we preferred Exxon as a play, but Chevron's looking good too. Where was it? So Exxon happy about these puts. These puts show $8,000 negative in our portfolio, showing a $2,500 loss right now, even though it is miles from our break even at 43.50. It's $8 away from there, 15% away. But it shows as if we're losing a huge amount of money on the position. So we ignore it. That's all. There's nothing else to do. Just ignore it. Doesn't matter. They're wrong. Your broker is wrong. This is the wrong, the options are priced wrong. And that's why a lot of times we'll end up selling them again, or we might buy some longs. I'm not that in love with the oil industry. I like Exxon enough to sell the puts, but I don't like it so much that I want to jump into a long position on them. Pipeline people, Plains All American, they're fine. Here we're going to get called away at 18. The stock's at 14. It's actually quite low in the range. Should we take advantage and buy back the long calls? Probably. We'll probably buy back these calls because they're so far down. Tanger Factory Outlet. We've talked about them a lot. They're one of my favorite cheap stocks. The short calls, $1.03, not really worth buying back. Our target's 13. Our target's 13. They're at 12, and we got 2 years, so it's really nothing to really worry about. It's a right size position. I wouldn't want to buy more or do anything here. This is fine though. It's a good position. Love these guys, by the way, though. I mean, to just sell the 13 puts for $3.95 is a great deal because you're netting what, $9? It's crazy. All right, Cisco. What do we think about Cisco? We were aggressive with Cisco. We bought them pretty recently. I think we sold the puts a long time ago, and we bought the bull call spread recently. Now, well, we got killed. Our timing was terrible because we did it at 221. But there's really not much to do about it. We'll just leave these alone. I'm not jumping in it. Do we want to buy these short calls back already? Only. See, here's the thing. Do I want to spend $2,150 buying these things back? Not really. I'll be so, it's only a half cover, and I'll be thrilled if Cisco gets back to 50. So how am I going to be happier by buying it back? It doesn't change my life. Discover Financial credit card, again, another one got killed, bad timing on the entry, but that's okay. I mean, it's at 66. We have a 60-75 spread. The short puts are fine. So it's just something that needs to work its way out. Freeport in decent shape, great as a new trade. Not much to take advantage of. It's actually at the top of our range. We have a 5-10 spread with $10 puts, and it's at 10.28. So we just have to wait to collect the entire $5,000. Currently, it's 54 minus 5 something. So currently, it's like net $300. It's a $5,000 spread that's 100% in the money. We should really double down on this. We should really triple down on this. All right. I want to be clear about that. This is a 5-10 spread, okay? 10 of them, so it's a $5 spread times 1,000 times 1,000 times 10 contracts is 1,000. So it's a $5,000 spread, and we're about even on it. It's right now 54 minus 26, all right, well, 54 minus 52. So it's about $250 net. So $250 net for a $5,000 spread that is 100% in the money, even though gold and copper, where's metals? Even though gold and copper, well, let's take a look at weekly, give you a better idea. Gold is doing well, and there's no reason it won't continue to go well with the Fed, all the central banks cutting rates like crazy. So gold is in great shape. Copper is way down because of China, but will come back eventually. China's going to have stimulus too. And over time, people will eventually build stuff again. Even if they have to build hospitals, they'll build something. So copper gets used in constructions. The US mortgage rates just went all the way down. People need copper to build homes and such. All right, so home building is going to come back and be more popular. We'll talk about home builders later, if anyone reminds me. So nothing wrong with Freeport at all as a long-term play, because that's what they are. They're gold and copper, FCX. probably about 1/3 gold, 2/3 copper. They almost never go below 9. We only played an extremely conservative spread, and you can still make this spread. It will pay you back almost 20 times on cash. So we should just buy more of these. The fantastic freaking trade. Gilead, we took when the virus thing started, and again, this is a $15,000 trade. 10 times the 15 is $15,000 trade. It's way over the money. It was a 55-65 spread. It's already at 75, so it'll make 15,000 bucks. And currently the net is 10,000 minus 4,000, about 6,000. So $6,000 on this one will turn into $15,000, which is not 150% upside on this trade, and all Gilead has to do is stay over 65. All right, so I mean, you know, this is why when there's a crisis like this, I don't even, you don't even really need to get new stocks. The ones we have are fine. It's like, why are they so stupidly low? This is kind of ridiculous, isn't it? Look, these are incredible prices. The nets on these are ridiculous. This is going to make this is Gilead. It's like a blue chip company. It's going to make 150% in 2 years if it just doesn't fall $10, like 15%. If it doesn't fall 15%, it's going to make 150%. This one, if it stays flat, is going to make 2,000%. This is crazy stuff. That's what you take advantage of in a market like this. So that's why we don't rush to deploy our capital. We have all the time in the world to make these trades. I don't have to rush in and call a bottom or anything like that. Not when I've got this sitting right in my portfolio. And we've already vetted these positions. We've already ridden these out through a crash, and we're not upset with where they are. GM, somebody just said GM was the best auto company. I forget who said that, but somebody did in the news. No, that's MGM. GM, Morgan Stanley, right? Okay. So Morgan Stanley. Oh, and I think I forgot, I don't know if I got to this point or not before. What I was trying to say earlier was, you read the news in the context of saying, oh, that's right, we got distracted by the charts. So you just read the news, and this is my job. This is what I do for you guys, because I read constantly. I read way more than normal people should be reading, because you need to have a life. I also read very, very fast. So I consume unbelievable amounts of information every day. And I retain some of it too, which is good. Anyway, so I always remember, like, I read something about this, I read something about that, and it just gives me, like, I end up forming an opinion. But when you're reading the news and when you're looking at these things, this is a nudge. So it's like, here we are during the virus. What's the situation? What's the crisis? And Morgan Stanley is saying that they went to the GM EV event. They expect they're doing this and that. And now I knew this already, because we know that GM originated what they call I think it's called the sled design for the batteries. In other words, the battery pack is like the base of the car with the wheels attached, and then you just stick a plastic car on top of it. That's really all you're doing with the design. In fact, Tesla is built like that. It's a battery. In fact, when you go to the Tesla showroom, that's what you see. Well, I don't know if they're all the same, but the one in my mall, they've got the battery pack with wheels sitting on the floor, and they show you this is basically the car. Okay, that's what it is. It's like a Hot Wheel. When you take off the bottom of a Hot Wheel, the ones with that go electrically, you take off the top of the car. You can put a different shell on top of the car. It doesn't matter. Okay, it just goes through and it goes. It's a battery pack with wheels. It's a simple mechanism. You either and you have a throttle that adds power. So you basically, obviously the power is always there. So the battery pack has power. As you open up the throttle, all you're doing is allowing the energy to pass between the two poles of the battery, which makes the turbine spin, which then makes your wheels turn. And that's your whole engine. That's why they're so simple. That's the big advantage of electric cars. They're so simple. There's no real parts. You don't need all these bits and pieces to get the thing to go. So they're saying the GM's design is still working. They're an industry leader in battery pack technology, no matter what Tesla. I'm sorry, they're saying Tesla. Comparisons Tesla, which is the industry leader, but they're right up there with good head-on comparisons. They're saying, and anyway, so it's silly because overall, like GM should not be marked so much below Tesla. They're going to sell just as many electric cars as Tesla will realistically over time. But anyway, so there you go. So back to GM. So we like GM. GM's in our portfolio. And again, at a loss, this position is down. It's net 12 minus 8. Oh, wow. 12.9 plus another 6 is like 15,000. So it's minus 2,500-ish, 2,000-ish. So this is a negative 2,000 position. You get a $2,000 credit. The position is a 30-37 spread, and GM is only at 31, so it's low in the channel, this one. And we have to get back to 37 to make the money. So this is nowhere near as attractive as Gilead or FCX, which are in the money already. But still, it's a nice position if you believe in GM long term. IMAX, oh my God. This is so stupid. So IMAX, of course, nobody's going to movies in China and Europe. It's going to start all over. I mean, if this virus spreads, nobody's going to go to the movies. Box office was down. Total box office is total global box office. Oh, there you go. Thank you. 42 billion. So the box office is off $4 billion so far globally this year. We were talking about that yesterday. So now, obviously, IMAX is only some percentage of the global box office, but 10% basically. So business is down 10% for the year. That's the net of it. So that's also my job, by the way. So when I'm reading all this news and doing all this stuff, I'm also, I check all these facts in the background to make sure I know what the numbers are. Because any statistic you read, like you say, oh, box office off $4 billion, that's meaningless if you don't know what the box office is. Off $4 billion from what? But let's be realistic, though. The box office is off $4 billion from last year, and it's only freaking March. So if the box office was 40 billion last year, it was 4 billion a month, not even 4 billion a month, but let's say it was 4 billion a month last year, and already with 2 months gone in the year, the box office is off 4 billion from last year. It's off 50% in 2 months. But that's not really how we look at it. But we say, how long is this virus going to last? It's certainly going to last another month. Then people aren't going to rush back to the movies. So we're looking. In fact, they just postponed. James Bond was supposed to open in April, and it's now pushed back to November. And that's going to happen with a lot of movies. It's going to be so that's going to compound the problem, because now there's going to be a lot of the big movies that were supposed to open in March and April aren't even going to open. And that'll mean who's going to go to the movies for what? So they're pushing back things. So the James Bond movie got pushed back. So you're going to lose. If you lost $4 billion in 2 months, that's half the box office. You're probably going to lose another $4 billion. So there's going to be $8 billion lost at the box office this year. Not to mention, this year was not going to be as big of a year as last year, when Disney was like phenomenal with all their releases. That's not going to happen either. They just don't have the same slate of movies coming out this year. Therefore, you're going to be off tremendously from last year. So we're talking at least 20% due to the virus, and it probably wasn't going to be a big year anyway. So we could be talking like 30% less business than last year. That is significant. And IMAX, unfortunately, only has short-term contracts, but it doesn't matter that the contracts are short-term as long as your intention is to roll them to longer contracts at the same low prices, right? So when the longer contracts come out, we do our rolls. Meanwhile, though, we sold these June 20 calls, and they're worthless, basically, so we're going to buy them back. We're going to wait for the next ones to come out, and we're going to do a roll. It's going to take us quite a long time to recover this money, though. This is very ugly. We have the puts. That means we're going to own a lot of IMAX stock at some point if this keeps up. And we have the long calls also, which are down tremendously. They're down to $2. We have to roll them out to a longer month. Right now, September's okay though. And we have to wait for this thing to recover and swing back. But we're at 14, we're at the money. Okay, so we still have plenty of time and a good chance. It's really the puts that we'll have to roll, but there's no hurry on those until we need them. And these short calls we can buy back though, because there's no reason for us to collect 18 more cents when if the stock does swing back up for some reason. Like, first of all, at this price right now, Disney could buy IMAX. A lot of people could buy IMAX. Netflix could buy IMAX. You know, and I'm not one of those people who says that kind of stuff, but I mean, you're talking about a value that's hard to walk away from. IMAX. Oh, it's 15. Wow. Okay. Well, hey, how is that possible? Wait a minute. Wow. Okay. It came up a lot today. So like I said, not a bad position. What was I saying? Yahoo. There. Nope. Wrong one. Nope. Where the hell was I? Oh, there it is. Okay. This is only $1 billion for IMAX. $1 billion. And if you look at the financials, they had 300 blah 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 million in revenues, and their income was $5 million last year. So okay, so let's say 50 billion, $50 million. They're now down to $1 billion. That's only 20 times earnings. But they've got a theater chain. If Netflix were to buy IMAX, they could release films in IMAX. They'd be have the studios beholden to them for them to take a picture, put it in IMAX, and then it would go to Netflix quickly or things like that. There's a lot of ways to do it. Or Disney, who obviously licenses a huge amount of revenue to IMAX every year. They were 40% of the entire box office last year. It would make very, very logical sense for them to buy IMAX. Okay, because 40% of that $45 billion is already Disney's money. They had to give it to IMAX. So they could justify it many ways. They could justify the purchase of IMAX if they wanted to. Anyway, so I think that well, obviously it's going up already, but that price is ridiculous, and it's still ridiculous. Anything under $1 billion for IMAX is completely ridiculous. So we love them. Joe, the coffee ETF, this one's working. It's going on track. And again, we have the 25-30 spread. It's at freaking 37. It's 20% above our spread price. The spread is $10,000 spread, and currently it's at net 9. Oh yeah, it's like net 8, so it's close. All right, so I'm not saying it's good for it's only going to make 25% between now and September, so it's too boring for us. That's the funny thing about the PSW system. It's like, oh, what, 25% in 7 months? No, that's not a good trade. Let's find something better. LB, love LB, and they're loving us right now. They pumped back up because they sold Victoria's Secret, and we talked about that last week. It was a good sell-off. Again, $5 times 50 is a $25,000 spread. Currently, 12 minus 8 is 4,000. So here's another one. This is $4,000 or $5,000 net price for a $25,000 spread that is totally in the money. And look at the jump up today, almost 10% up today. Because this stock is in great shape. They only got interrupted by the sell-off. And you see what the thing is, we don't give a crap. You know, this kind of stuff happens. We don't have to panic. We don't have to adjust. We just wait and see what happens. If it gets cheaper, we'll buy some more. If it doesn't get cheaper, fine, we're on track. We're on track. We're on track to make $20,000 on this position, and all they have to do is not go below 22.50. Now let's see, there's one I would say, yeah, that's worth doing, right? If you're gonna turn 5,000 into 25,000 in 2 years, that's a 400% increase in 2 years on a stock that has to drop 10% for you not to get the whole $25,000. That's just for you not to get the entire thing. It has to drop 10%. If you drop 20%, you'll still get a lot of your money. Now Macy's, another one I love, way too cheap. This one is not on track. We'll probably adjust this one because we own the $13 calls. That's not bad. We own the $13 calls. We sold the $20 calls. It's a little early to buy them back, but very tempting because it's too cheap. And the puts I'm not worried about because the puts were 15. We sold them for 450, so our net is 1050, and they're at 1240. So I don't care what it says here. We're not losing any money. Middleby. The catalyst for Middleby, I like them anyway. They make Viking ranges, but they also make a ton of, they make huge amounts of industrial ovens and things like that for restaurants, but they make Viking ranges. They make other kitchen and cookware and such. But they had a deal to supply McDonald's with new ovens for their breakfast sandwiches or something like that. And that's obviously gigantic rollout. Any company getting a contract like that is huge. That's why we jumped on them at the time, back on 123. In this case, we're right in the middle of the spread. It's basically on track, and it's basically even. So it's still a good trade for a new trade. It's going to be a $20,000 spread, and currently it is a net credit. So again, that's going to make a shitload of money. The MJ ETF, this is an old loss. So on the whole, the new stuff is doing okay. The old one is not coming back very fast. Although, look what happened though. It's a $15 call in 2022, and we're at 14.25. It's not dead. We've been sitting on this thing since October. So it's not actually dead. MJ. All right, so we're just waiting to see if it comes back, and we need it to come back quite a bit. But overall, what do we sell this thing for, or what do we buy it for? I mean, these are fine because we took those when it was really low. These we took too early. We bought the $15 calls for 7. We need 22 to break even on that. We need a pretty big move back up. Here, we sold the $30 calls. Oh, I'm sorry, that's part of this spread. Here we sold, actually we sold the $30 call, so we don't need that much. We're net 5 or a little bit less than net 5. So we need 20 to break even. So forget those two. Those two are a pair. They're down $7,000. The new stuff, the new stuff is down. Huh? Silly me. Oh, why is that? Because we sold the puts and we sold the calls, and then we sold some more puts. This is a short-term sale. So we're just waiting for this. And if this tracks in around, if this hits our goal, we'll make good money. And if it doesn't, we're going to roll the position. That's, not exciting. It'll make money in the end, but it's just going to be tedious. It's like a butterfly play. Philip Morris, we got aggressive on this. We bought back the short call, so we're waiting for this to come. The whole thing dropped. We bought back the short call, so now we just have the naked longs. We didn't feel like rolling them or anything. They're right at the money, and we're hoping it comes back. I'm in the industry now because of the marijuana companies, so we care about vaping products. There's a lot of marijuana vaping products. Things are moving to ceramic cartridges, and they've solved the problem about the lung thing because it was basically it's just bad ingredients. I mean, they were using vitamin E as a base for the vaping cartridges, and vitamin E, if you heat it, becomes incredibly bad for your lungs. It's deadly for your lungs when you vaporize vitamin E. So that it was idiotic. People were idiots and making these cartridges, and it wasn't Juul that was doing it. It was other companies giving everyone a bad name. Like the crappy Chinese companies. But the problem is, when something like vaping becomes a thing for teenagers will buy any piece of garbage that's cheap. It doesn't. So in other words, they like the idea of vaping, so they'll buy if they see a $1 vape pen in a 7-Eleven versus a $5 vape pen at a vape shop, they're going to buy the $1 pen at 7-Eleven, or the cartridges or whatever. And that's going to be obviously nowhere near as good, nowhere near the quality of the other, and they don't think about that when they're putting stuff in their lungs. And the FDA didn't have anything under control there. So that's where all that came about. But the whole thing will be resolved, and that's Philip Morris. All their problems came from they bought Juul and had to write down a huge amount of money, like $10 billion of write downs. So that's going to turn around and become huge for them. So we can just be patient there. SunPower, I can't believe this isn't up more. Let's see where we are. SunPower is in the middle of our range. It's 40 times 7 is $28,000 spread, and currently it's net $5,000. That's a no-brainer. TD Bank, too low in the range for sure. Definitely something we want to get more aggressive on. TD Bank. Whoa, look at that. All right. They just tanked the Canadian dollar too. The Canadian dollar just went off a cliff today because the Bank of Canada matched the Fed with a rate cut. Look at that. So they went from 77 to below 75. They lost 2%, really 3% on their currency pretty much. So if you're a Canadian, you are now worth 3% less than you were this morning. So you can thank the Bank of Canada, or than you were in January anyway. Like horrifying. And we're not much better off in the United States either. We're down 2%. In a few days. In 2 days, we're down 2%. In fact, in America. See questions. Robin says, what should I roll the SKT 2020 March 30? Bleh. March. I take it you have 30 of the March 14-16 calls. So SKT. SKT. So you have the March 14-16 spread. Well, that's kind of dead, isn't it? Yeah, you waited way too long. You're not really rolling. It's a dead play. You know, we're in SKT for the income. You know, they pay off a huge dividend, and so we're in the stock for the income. I don't like playing this as a spread. It's too unsafe. In other words, if you own the stock, you don't care about the price of the stock as long as they keep paying the dividend. And they're great dividend payers. They've never dropped their dividend yet, and they're very proud of that. So I doubt they're gonna. It would have to be some extremely adverse conditions for them to lower their dividends. So SKT, I would buy the stock for $12.20. Because I mean, that's not a roll. It's a dead position. It's no sugarcoating it at all. But if you buy the stock for $12.20 and you sell the $10 calls, you can't really. You sell the $13 calls for $1. I would ask for $1.10 or $1.20 though. But if you can get $1.10, $1.20 for these, you'll be in. Let's say it's $1.20. You would be in for net 11. And if you want to, you could also sell the $10 puts. They're saying $2 right now. I mean, you're going to get at least $1.50. That would drop your net from 11 to 950. Okay, and then with 950 on SKT, we go back to Yahoo and we find them. SKT. See, they're at 1.27% today. They're paying out $1.43 dividend. So if you drop your net to 950 and you get $1.43 dividend, that's like 14-15%. So in 2 years, you're going to get a 30% dividend, and you're going to get called away at $11, which is another 150 in profit, another 15%. So by buying the stock, selling the $11 calls, and selling the $10 puts, if SKT simply holds 11, you're going to collect $450 in profits. That's 50% of your $950 in profits in 2 years. That's the way you play this position. Don't play them to go up. You know, that way you don't even care, because even if it goes lower and you end up buying more, you'll end up at net 10 on your, when you get assigned more. If you get assigned below 950, then you sell some $10 calls for $1, and you're dropping your net to like 850 or something like that. So that's the way to play this. It's just you want to just have a low entry. As long as they keep paying that dividend, that's what you're in it for, right? I mean, every year you're getting 15% dividends. What else would you want? I mean, that's your retirement account right there. We can go back. Oh, wait, there it is. Here's my favorite compound rate calculator. So let's say you have $50,000 worth of SKT, okay, and it pays 15% for 20 years. All right, let's see how that does. $818,000. That's pretty good. So if you want to be a millionaire, basically buy $75,000 worth of SKT, the way I just said, and just sit there. And all you got to do is sit here, wait for the money to pour in. That's their dividend. That's not even counting making money on the stock. That's just what they're paying you every year in dividends. You have to reinvest the dividend, of course, but that's not bad. But yeah, you don't play a dividend. You don't ever play a REIT, and they are a REIT. Don't play a REIT, a dividend paying stock with a high dividend. Don't pay them to go higher. How are they going to go higher when they're paying out 90% of their earnings as dividends? Where's the growth? They're giving away, they're distributing all the growth of the company. So the stock price doesn't really appreciate. They tend to be very flat, those kind of stocks, because they're paying out all the profits. They're not really growing the company very much. They're just paying all the profits out every year as they come in. So you can't play them to go higher. That's not how they work. You've got to play it for the dividend. SunPower, we talked about TD, also stupidly cheap, great stock, great entry. Toll Brothers, well, we lucked out here because we picked up the builder, and of course they just took off. Boy, we are good with our picks, aren't we? This portfolio is fantastic. Every single position I look at is like, yeah, we want to be in that. So here's Toll Brothers. Get it while it's hot. Obviously, the very low rates are going to be super helpful for these guys. We picked up the 33.40 spread right on target. It's at 40. We sold the $35 puts. 15 times, 15 times 7. Oh no. It's 35.85. Is that right? It's $8,500. 1,500 times 7. No. $11,500. Is that right? 1,500 times 7. $10,500. There you go. $10,500. I used to be able to do math way better than this. So $10,500 spread. Currently, that's 12,000. Currently 3,000. So 3,000 will make 10,500. It's going to make 200% if toll holds 40 through 2022. So it's going to make 100% this year and 100% next year if toll holds 40. That's a keeper. Okay, we'll keep that. Oh dear, Textron. Wow, what happened to them? Ho ho. Okay, now these guys we'd have to fix. Wow. They got hammered. What did they do? That one I got to look up because I don't remember hearing anything about something bad happening. Whoa, Jesus. Okay. Obviously they're having trouble. I don't know if they're having specific problems or if they got sucked down with a sector, but that's pretty odd. Oh, it's because of the Boeing thing? Why is tech? Okay, yeah, I'll bite. I'll bite Zach's. What happened? They earned $1.11 a share. That was better than consensus. The bottom line declined. There was a one-time charge. This year-over-year can be attributed to low segment profit recorded by the company. Report figure, manufacturing revenue, aviation in the quarter under review, revenue segment rose in aviation. That's interesting. They delivered 71. Oh yeah, because they're I think they're Learjet or somebody. They're one of the good private jets. The helicopter division was okay. Textron Systems, industrial decline. Well, there's that general slowness of things. Nope, I still like them. We would certainly amend. So Textron, we take advantage of the dip. We're gonna roll the calls down. We're gonna move it to 2022 if they have it yet. They didn't have it at that point. So TXT, there's nothing really wrong with them. The time isn't gonna fix. Ooh, okay. They don't have 2022, but they do have December 21st, 2021. So we're gonna roll out to here. I don't know what we have, but So we have the 45 calls, they're 340. We would roll these out to like the December $40 calls or something like that. We'd have to see what we like. And we'll just play it for a longer play. That's all. We're only in though. See, we're only in for net 9.3 minus about 6, so about $3,000. We're in this thing for. Doesn't matter what we lost. It's a matter of whether we think we can pick up a position. So if we look at Textron and we say, okay, well, we've got the 45 calls. It looks like they're going to have a rough time getting back. The channels lowering on them. They're going to range out here. Probably not going to get over much over 50. So we shouldn't play them higher than 50. So we want to roll to something long-term, fine. Lower strikes, fine. And we look at the 40s, and they're 750-ish for the 40s. And if we look over at 35s, are another 3. That's too much to spend to go to 35. So we'll take the 40 spread. And we already sold the, what short calls did we sell? Well, oh, they're the Januaries. I think we would leave these. We sold the 55 calls. They're still $1. I wouldn't pay $1 for them. So maybe we'll roll to more of the 40. Let's say we roll to 25 of the 40s, and we sell 10 of the $50 2022 whatever the hell, December whatever. We'll sell some December 50s, like 10 of those. So we'll be fully covered, but these are going to expire a year sooner, and then hopefully we'll be able to pick up more cash on the roll. And that'll be an overall decent position. And the puts we can just roll out to more at a lower strike, and then we'll be fine. So that's going to be the adjustment there. Vail, another mining concern, also got hit pretty hard. This one we would definitely take advantage of. So we would buy back the short calls. We're right on the line here. I don't know if we would want to adjust this much. I think we basically just buy back the short calls and wait for a bounce. Viacom also tremendously hit. We already bought back the short calls on Viacom, but now we should certainly consider rolling that lower because this is getting to be like a really silly price. And so we're definitely going to do that. We're going to roll the 35s to the 25s or maybe the 20s. So we're going to invest more money, probably $5, to roll down to the 25s at least. And all that's going to do though is add $15,000 to a net. Well, I don't know what we sold the other ones for, but it's a net. Probably, let's say we sold the other calls for like 7,000, it'd be like a net 5,000 position, and we're going to spend another $15,000. So we'll end up spending $20,000 to own the 2022, let's say 25 calls, and then eventually on a bounce we'll sell some more. And then WBA, love WBA. They're on track. There's nothing to change here. They're making money. There's nothing to change there. The net of this position is currently $10,000, and it is a $30,000 position. So another one that's going to make 200% with very little effort. So on the whole, this portfolio right now, there's almost nothing in it. We just went over it. So, do it on the replay. You can do it one by one and pause. But I'll be writing it down tomorrow and Friday in member chat. But on the whole, you could start this portfolio right now, and there are tremendous, tremendous profit potential here. This portfolio is easily going to make like about 100% next year, or 100% on these positions. These positions aren't using up all the buying power of the portfolio. But there's nothing wrong with any of these, and that's the trick. So in other words, when you have a downturn like this and you're reviewing your positions, you don't start off looking for more positions. See, we talked about that. We made a watch list the other day, and I think it's even in, let's see, certainly yesterday we talked about some of the positions. Robinhood is back online, so you guys can trade. So people would always tell me, like, Thinkorswim, they always like, why do you Thinkorswim? They're expensive. I'm like, well, because they always work. Even when the crisis was on back in the day, they were still working. What was I thinking of? Watchlist. What? Really? Wasn't that yesterday we did the watch list stuff? It's killing me. Okay, here you go. So the watch list, we did this last week and we did it on Monday. I went through the entire watch list and we summarized. I did very quick summaries of what's on the watch list and where I felt it was right now. So Barclays, I said not in love with them, can't get a clear line on the financials, -4. I didn't like the fact that Fed's lowering rates and stuff. Micron didn't come down very much, so I gave them a 5. FCX, as we just said, I love them at this price. See, and that was Monday when they were down here. Prudential, I said too worried about business interruption claims, weather claims, so I gave them a 6. S&P, I'm not touching China Petroleum right now. Lennar didn't come down enough, and now it's going to be, I'm sure it took off at this point, so it's too late. LEN. Yeah, see? So it didn't come down enough to be a real bar. You know, that's what I was thinking on Monday. I was like, it didn't really come down enough, so I'm not too wild about it. And now it's back up, so it's back to its all-time highs. We don't want that. And we already have toll. KHC, love them, still cheap. Might add them to the long-term portfolio. UBS, I said I like better than Barclays, and they're still cheap, so they haven't taken off yet. CBS is now Viacom. I gave them a 9. Love them down here. We just talked about that. Goldman Sachs, good price, but not cheap enough for me. So, Capital Financial, no. MetLife, no. Not another insurance company. MFC, another insurance company. Lloyd's, another insurance company. I guess when I was looking at stuff, I was looking for like sectors and finding bargains in the sectors, and I jotted things down. So, you know, I mean, look, we had a watch list, but just because something gets cheap on the watch list, you got to say, why did it get cheap? So, you know, we were hoping the insurance companies would come down, but not for legitimate reasons. Like there's a huge insurance risk globally, not just in America. There's a huge worldwide insurance crisis is brewing here. Apple 260, too late. More on the watch list. X, love it. Assuming they survive, it's very cheap. X. M, I just talked about, crazy cheap. Ford, you know. Mylar, yes, I like them down here. Encana, not now with that kind of thing. ADS, too much turmoil. Tech, it's a good time for basic resources. They're still cheap right there. STLD was too cheap to ignore. I said I like them a lot. NRZ is another REIT, like them. I always say, in fact, I said the $2 dividend makes them a 9 because I mean, it's like so much money they hand you. Gap is, you know, that's incredible at $8. This is ridiculously cheap for the Gap. That's a good one. LB, love them but not cheap anymore. Huntsman is a nice boring company. I like them. Goodyear tires, Goodrich tires, one of those tires. Very cheap, great. So I love them down here. And see what I said? I said I like them if you can make them cheap with options. Here's what I mean. They're at $9. Okay, so it's not just that I like the company. It's a good company. It's a good value down here. We're not in a good spot in the auto cycle, but that's not really important. What's important is that because they're 926, I can sell the $8 call for 230. That's going to take them from 9 to 7. I can sell the $8 puts for $1.85. That's going to drop my net to $5.15. So now I'm getting the stock for $5.15 and I get called away at 8. So that becomes a no-brainer, right? They have to fall to 8 before you can lose any money. And if they don't fall to 8, you're going to make $3 on your $5 investment. You're going to make 60%. You know, when you can make 60% for taking hardly any risk, that's what you do. That's like putting money in the bank practically. There would have to be a global catastrophe for this stock to lose another 50% of their value. And what you can see here, I mean, they already dropped from 17 to 9, so they would be down 75%. If they drop down to 5, they'd be down about 75% off their highs. And this is all because of the virus and China issues and whatever. It's all that stuff. It's mostly the virus stuff that came up during the year as things dropped off of the auto industry. When it comes back, at some point, some way, somehow, they're going to be back around a $12, $13 stock. You can now buy that for net $5.50. That's why I said that. I said at this price, $9.50, I like them because you can make them much cheaper with options. Now, you could be more aggressive than that and say, well, why are you going to make a cutoff at $8? Why are you going to cap out your earnings at $8? Because I like that. Because for cash that's, in our long-term portfolio, we have not so much cash, but margin sitting on the sidelines doing nothing, tons of it all the time. We use very little of our margin. We have $1 million worth of margin. It's very surprising if we use more than 600,000 of it. That means we got $400,000 sitting around doing nothing. So you take some of it, the margin, and you put it into a position like that. So you take a position in Goodyear, whatever, and let's say we put $50,000 to work in the position. And then we're going to get back $80,000. We're going to make $30,000 on margin that's just sitting around doing nothing. Got $400,000 in margin doing nothing. I take 10% of it, put it into this. It's going to bring back $30,000. That's better than money in the bank. Is it riskier than money in the bank? Sure, it's riskier, but it's not that much riskier. UTHR, not on sale. Good biotech though. TWO is another REIT, also good price down here. AGNC, it's another REIT that we like, also good. PK, no, I wasn't happy about them. BSM I like because they manage. Yeah, they're a reserve manager. They don't actually hold the stuff, so I think that's not bad. 8's a good price for them. So again, it's the same logic though. So if you go to BSM, you can't go too far out, unfortunately, these guys. But they're at 855. You can sell the 750 calls for, I don't know, $2. It's hard to tell because nobody's trading them yet. Yeah, see, these were $1.75. So you can get $2 for these for the 750 calls. That's going to drop your net to 655. You get called away at 750, and you sell the 750 puts for 60 cents or so. Be probably 60 cents. So it's not a huge winner, but it's a nice little play, and you can make some good money. That's all. It's like quick money because it's only into October. It seems like nothing, but it's 855 minus 2 is 655 minus 50 is $6, and you're going to get called away at 750. So that's a 25% profit between now and October in 200 and something days. So basically in 8 months. So in 8 months, you're going to make 25%. It's not bad. It's not exciting, but it's a good bargain. HFC is a low-cost refiner, still super cheap. And again, I think OPEC's going to turn things around. This is a great way to play oil because refiners, it's not about the price of oil. It's about the net of the price of oil versus the gasoline. Now, of course, it's really the net of the total difference because, when they open a barrel of oil and they refine it, they're going to turn it into about 19 gallons of gasoline. But they don't only use 19 gallons, all the other stuff gets used too, so the refiner sells it. But there's a thing called the crack spread. So the crack spread is basically how much money per gallon are you making on your gasoline that you're selling. So let's say they're getting $2 or let's say they're getting, just for example, let's say they're getting $2 and they sell 19 gallons of gasoline out of a barrel. So effectively, they're getting $38 in gasoline. Now, so depending on what they sell all the other stuff for, the other distillates and the diesel and so on and so forth, that determines the crack spread. But let's say they get $2 a gallon for the whole barrel. It's a 42 It's a 42-gallon barrel. That's what it is. It's 42 gallons in a barrel of oil. So if they get $84 back and they're buying the barrel of oil for $50, they're making $30. That's what the crack spread is. How much money do they get out of the barrel versus how much money when they open the barrel does it cost them to open the barrel? And that's where they make their money. It doesn't matter whether it's oil is $40 or $30 or $50 or $100. It's a matter of how much money profit they're going to make. And generally for refiners, they'll make more money as oil is lower because, as you know, just because oil prices go down, it's not like at the gas pump this week they knocked 25% off the prices, right? But oil's down 25%. Oil's down. Oil is down from 55. Well, it's back up now, but oil is down from 55 to 45. That's $10 is 20%. So oil is down 20%. Did you get 20% off your gas this week? No, of course not. It's not how it works. Gasoline went down 20 cents, maybe 14, 15%. So gasoline is down 15%. Oil is down 20%. It doesn't keep up. So where else were we? Oh yeah, and that's HFC. And I don't know if I did any more. Nope, that was the end of those. All right, so now you're all caught up, and we'll take a quick look at the other portfolios, but the long and short term are the main ones to go over. Butterfly portfolio. Oof, wow. Butterfly, wow. Oh, because of the Apple. Because Apple came back. So Apple is now doing fantastically again. Holy shit. Now, we cut this position back considerably last week because I didn't want to take the huge risks that we had with all that thing. We cut the position basically in half. But it's working out fantastically the way Apple came down and came back. So, geez. So now this portfolio is rocketing higher. Disney also is coming back nicely, so we're doing good on Disney. I got to think about whether we want to do adjustments. I'm going to get into every single position. Mondelez, here's MJ again, Whirlpool, and US Steel. So all good positions, nothing wrong with those. Dividend portfolio, that's down a bit. That's down a lot, really. It was up 20%, but a lot of this is because we were selling a lot of premium, and the premiums are really high right now. So a lot of that will come back, but we'll go through that and see if there's anything we want to take advantage of. Although I think I said that we weren't going to touch the dividend portfolio. I think we decided to experiment and see what happens if we don't touch it at all. So maybe we're not going to do that one. We'll just let it ride out the crisis and see how it plays out. Earnings portfolio, that's down. That was up about 10%. Now it's down 6.8%. We just have to look at these positions and decide what we want to do with them. As I said, this has turned into more of a long-term portfolio, though, because these positions are generally long-term. They were ones that we went in for earnings plays and we stuck with over time. The future is now portfolio. I like that one. We got to add to that. We haven't done much with it. If it ever resolves itself. Wow, what's wrong with this? Anybody have questions while we're doing that? Holy crap, somebody wrote me an essay. Who's this? John. Let's see, since it's taking so long. You suggested the SKT spreads, December 11th in Phil Stock World, blah, 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 blah. Notwithstanding agreed from here, our 5 trade ideas can make this much money in just 4 months. So very Merry Christmas to all members. Since 3 of our 5 trade ideas have gone nowhere, how about we bonus trade them into Easter's? SKT was practically our trade of the year and still love them at 16. Earnings in mid-February through March option contracts would be do or die on that report. So I guess we'll go for it. We're buying the March 14, selling the March 16s, sell the 15 June 14 puts, and that's net 250 on the spread, but there's only 100 days to play. The upside is that, and that's because we're selling puts on upswing instead of much downswing, which is much better. So what should we have done? Well, yeah, having the position, what you do with this kind of spread, and he's right, I did actually talk about that spread at some point on back on 12/11. We actually did talk about this SKT spread. And anytime you take a bull call spread like this, the March 14 calls were 220 and the March 16 calls were 95. So your net on the spread was about $1.25. The trick is now the net of the spread was $1.25 and the March calls were 220. What you do to preserve your money on a spread like this is when the price of the March calls drops to the net of the spread. So in other words, when the March calls fall from 220 to 125, that's when you have to roll them. You don't wait till March. You have to take action when your calls drop to the net price of the spread. Why? Because if you take an action then and you do something with the 125 from the March calls, like even if you're investing more money in them, you roll into a longer month and a lower strike or so on and so forth, you've recaptured that money and put it back to work. You haven't lost it because you've taken it and bought something of value, and that something of value is something that is on sale at a lower price than where you started. That's the difference. And I strongly apologize. I forgot that we ever did that. But the trick is what you do after the fact. And so when you pick up a bull call spread, your big protection. So like here's SunPower, right? The net of the spread was $2, 220, right? So if these calls, which were 450, if they ever drop to 220, that's when you've got to take action. You take action when your call price, the long calls, fall below the net price of the spread that you paid. As long as you take action with them, you can move them to something that has value at a lower, longer strike. And again, these calls may have lost money, but you're salvaging the net cash that you put into the trade and putting it to work on other calls that have also gotten cheaper over time. So you're buying a good value and utilizing the money that you put into the spread already. You're going to leave the short calls hanging that you had already. You're going to leave those out open and then you'll resell later. But that's generally our main strategy for that sort of thing. So next time that happens, and I'm sorry this one didn't work out, but next time that happens, just make sure as soon as you see your long call strike, your long call price falling into the range of what you paid for the spread, you've got to do something about it. You can't just watch it deteriorate away. Okay, because then like I said earlier, it's dead, unfortunately. On WBA, see, that never went into one of our portfolios. That was just a play we talked about. So unfortunately, it wasn't something we were tracking. On WBA, the short calls are way below target. Is there any different opening you would make if you have nothing now on WBA? Well, like I said on WBA, that was in the long-term portfolio, right? The thing about the WBA though is not much profit in this position. So what are you saying about the short calls? The short calls are way below the target. They're not below the target. They're way above the target, or the stock is above the target. Is that what you're saying? Either way. Anyway, this is right in the range that we want to be in, though. See, you got 2 years for it to get to 55. WBA is lower in the channel than it was, but it's fine as it is for a trade because the net of the spread is still very cheap, and there's nothing wrong with our $55 target. Our $55 target is extremely achievable in 2 years. So no, I wouldn't do anything different on this one. So it's basically just fine. You could theoretically take a lower trade. If we want to look at WBA, where am I? So we have the 40 and the 55s, and then the question is, what if we instead had the 50s? So the 40 55s are 11 minus, let's say 4, so that's 7. And if we did the 35 55, that would be about 15 and sorry, 15 and 550. So let's call that 10. So it's a lot. It's $3 more to be a little bit lower in strike, and it's a big $3 though, because it's a, you know, in other words, your spread is still a $15 spread. So since I think 55 is a reasonable target, and the 40-55 spread will make I forgot, was it 7? I don't remember. Anyway, it's going to make $3 more. $3 more is 20% more for the same outcome. So it's not, unless you really feel more conservative about it, why would you roll to the lowest strike and pay $3? That's only something you would do if you're not confident in the 55. We're very confident in the 55. GT, do you think the yield is safe? Well, we don't really care if we're playing the spread, right? So I do believe that they are obviously going to have issues. You've got 0 car sales going on in China right now. That's going to be devastating for them. Who knows how long that's going to take to come back. If people are not going out in Asia, they, you know, less miles driven mean less tires sold, right? Bottom line. So not that China's a heavy driving place though, so it's not on the global scale, it's not going to have a huge effect. But let's say in Europe and people shut down, in Italy, people aren't going around too much anymore. So, you know, if you start having countries where people are staying in and not going out, not using their cars as much and so on and so forth, if you have 10% less miles driven this year, then you're going to sell 10% less tires, right? So therefore, it's going to be an impactful to the bottom line. That may or may not be enough to cause them to suspend their dividends. You know, I mean, I wouldn't dig into my cash just to pay a dividend. I just learned that lesson at PSW Investments, okay? Because we did that. We thought we were having a short-term interruption. We paid a dividend, we drained out our cash, and we shouldn't have paid the dividend. That was a mistake. Okay, a lot of companies make that mistake, and I made that mistake because obviously it's kind of, you have the pressure where people really want to get their dividend checks, and we had been paying them consistently. We paid dividends every quarter consistently, and I didn't see a reason just because we were having one rough quarter to not pay a dividend. But then boom, the second quarter, the next quarter after that did not improve, and suddenly we were short of cash because we shouldn't have paid the dividend. We would have never had a problem had we immediately said, you know what, we should hold on to the dividends. But we didn't do that. It's a mistake companies make all the time. So I learned my lesson. I wouldn't do that again. Okay, so as soon as you're tight on cash, you should immediately cut the dividend, because a dividend should not be considered a guarantee. A dividend is a bonus. Dividend says, hey, we're doing well, so here's some money. You know, I mean, it's not a REIT. We're not a REIT, and Goodyear's not a REIT. We're not obligated to pay a dividend, but if we're having a good quarter, we pay a dividend. So is it safe? I don't think so. I think that if they're intelligent, they're going to hold it up. And Burn says the $55 call is closer to $3.90 than $4. I know. I was just estimating for the example. Point is, though, I think it's fine. I think the spread is fine on that one. All right. So, all right. Let's just finish up the portfolios. And where were we? We were on. I went to all that trouble for the futures now. I was waiting, and then we zoomed off it before we even looked at it. How stupid. Way to go. There it is. Good. So the future is now, holy crap. No, this is not the future is now portfolio. What? Broken, stupid thing. Oh, there it is. Okay. So, look at that. See, this is the benefit of picking futures now stocks. They're still up 3.8%. We have Beyond Beef, so they're doing very well. We sold the $60 put there at 100, so that's silly. Look at that. You can still make $4,800, so you can still sell those for $960. Even though they're $40 in the money. That's how volatile people think this thing is. And good old SunPower, which was close to being our stock of the year this year, they're doing fantastically. Not worried about them at all. So that's an easy portfolio. This is 7 times 20. This is $28,000 spread, and the net is $5,000. Holy crap! Really? Wow. Yeah. This is a $28,000 spread that you can buy for about $5,000. How great is that? I love options. The Hemboka portfolio, we can't trade the Hemboka portfolio, and that's been bad, obviously, for the, in the crisis. We haven't hedged it, we couldn't trade it, and I'm not sure if we're going to keep this portfolio active because they're not doing the radio show anymore because they're so busy in Thailand. And the money portfolio, another portfolio we can't touch, and that one is flat now. And do we like these positions? SunPower, good old SunPower, not worried about them. Freeport, love them. Gold is our trade of the year. IBM, one of the greatest stocks in the history of mankind. Grade 4 new trade. Here you go. So IBM, gold is already taken off, so that's probably too late on that one. IBM, though, this is 20 times 8. It's a $16,000 spread. And it is currently net. Ooh, it's a net credit. Look at that. Or right about, it's basically net zero. Highly recommend this one. So all IBM has to do is get to 140 bucks by 2022 in January, and your $0 net cash investment will turn into $16,000. I don't know what more I can do for people. I really don't. I mean, how much more money could you want to make on trades? So nothing wrong with any of these trades. And by the way, this is what we do, because this is only one quarterly. I only do this quarterly when I'm on the Money Talk Show. And so I pick the most bulletproof trades I can find, and that's what these are. And then good old IMAX. IMAX is killing us, of course, but it's really not that bad. Because we only added them just recently. So IMAX at 15, and it's a good spread, and the net of the spread, oh, it's another zero spread, and it's $10,000. So here's one with net zero cash. You can make $10,000 on that one. And that's by September. So that's like infinity percentage gain in 7 months. And all IMAX has to do is get back to 20. It's at 15 now. It's going to be a little tricky, but I think by September, all we have to do is have a good summer season and everybody's going to relax. Or like I said, though, IMAX might get bought. So it's not like you can just sit down and wait for this to happen. They are way too cheap. There's a lot of people who would do well to buy these guys. All right, so that gets us all caught up. I'm going to officially make portfolio changes over the next 2 days. We're going to be doing a lot of aggressive positioning. The Dow is still currently up like 800 points. Here's my charts. So the Dow is up 800 points at the moment. Oh, that's WBA. Huh. Oh, I like oil here for sure, because oil is now under $47, so above the 47 line. I'd like to go long on oil because OPEC is certainly going to do something. In fact, let's do that for next week. This is a no-brainer to me. So if we go to there and we go to CL, and I knew it. Come on. Fine. I'll pay the penny. So we got 2 longs on oil. Ooh, 46.90. What? That's not good. I'm going to work on that and try to bring it down a little bit if it goes down. Anyway, so we have 2 longs on oil just below $47. And I expect oil, when the OPEC makes their decision and they come back, I think we're going to have a nice pop on that. So we should make some good money. Otherwise, we're fine. The S&P got back to 3,100. I'm very tempted to short that, but I'm not going to right now. But I do believe in that short for sure. And if it goes below 8,800 on the NASDAQ, I would reshort that again too, because we made some really good money earlier today, 4,000 bucks. And it would have been more if I was paying attention. I should have had 5. I'm very upset about that. So if these guys hit 31 again, I'm going to certainly short the S&P. Below 88, I would short the NASDAQ, and oil, we just took the long. So that's where we're going to leave that off. All righty, so hopefully we can make some money. Thank you, everybody, for stopping by. I appreciate it, and we'll do it again next week. All right, take care.